So there is some good news and some bad news. The good news is that the US stock market has hit new all-time highs, and with the index roaring higher, we've been able to cash in a few nice trades on the website. The bad news is that we're probably going to see the market get rug pulled in the month of July. About a month ago, we looked at this chart with our clients at Bravos Research, and it showed that fund managers were severely under-allocated to US stocks in the month of May. Now, we don't yet have the data on what that looks like in the present day, but it's safe to say that fund managers have very likely amped up their exposure to US equities in a significant manner since then. Until recently, we had a situation where most retail investors and most institutional investors were concerned about downside risk to stocks as a result of Donald Trump's tariff policies. Now, stocks have obviously rallied quite severely since the month of May, and a lot of this has been driven by a combination of FOMO, where investors are buying back into the market to avoid missing out on profits, and short squeezing, as investors that were hedging against downside risk need to cover their short positions, forcing them to buy the index. This is why these kinds of V-shaped recoveries can be so violent. Similar to 2020 and 2019, the index is immediately taken back up to all-time highs because of all of that forced buying that is taking place. But while the index itself has powered through as a result of that forced buying, the average stock within the S&P 500 hasn't performed well at all. In fact, this line right here shows us the percentage of stocks within the S&P 500 that are trending higher at any given point in time. Right now, it is still below 50%. So in other words, while the S&P 500 is at all-time highs, we have the majority of stocks within the S&P 500 that are still trending lower. Now, this by itself is not the end of the world. You can always see this line catch up. But it does tell us that right now, there are still very much underlying concerns on the average S&P 500 stock, and that most have actually not participated in this big rally. The big run-up on the index has been fueled in large part by just 4 companies: Microsoft, Nvidia, Meta, and Netflix. Since its April low, the S&P 500 has rallied by roughly 20%. Microsoft and Meta have rallied by 40%, double the S&P 500's performance. Netflix has rallied by 50%, and Nvidia has rallied by 60%. Now, just keep in mind, these 4 companies together make up almost 20% of the actual S&P 500 index. So their extreme outperformance during this rally has been in large part what has lifted the index higher. And that has created a divergence between the cap-weighted index, the S&P 500, and the equal-weighted index, the RSP, as the cap-weighted index has benefited immensely from these very strong recoveries in those handful of extremely large technology companies that make a huge portion of the index. This divergence by itself is not the end of the world. We actually saw something very similar in 2020 during the recovery from COVID-19. In August of 2020, the S&P 500 made a new all-time high, while the RSP, the equal-weighted index, was still struggling significantly below its previous all-time high. But look at what happened right after the S&P 500 made a new all-time high. It corrected back lower by roughly 10%, digesting its gains before eventually it did move higher. This is a textbook scenario after a rapid V-shaped recovery. Investors rush back into the market, pouring into a handful of large cap companies, and right as the index makes a new all-time high and everyone is convinced that the market is heading higher, that's the moment where it actually corrects and digests its gains before resuming higher. We saw exactly the same thing in 2019 following this V-shaped recovery right here. Right after the S&P 500 hits a new all-time high, you experience a correction of roughly 7%. And we can rewind all the way back to 1998 to see another example of this. We saw a very similar rapid recovery in the market, a W-shaped recovery, where the S&P 500 index quickly rallied all the way back to all-time highs, and shortly after it made that new all-time high, the index corrected by about 5%. So the combination of a lack of participation from the average stock, the big mega cap leaders being quite a bit overextended right now, and the stock market making a new all-time high makes us think that the market could pull back a little bit in the month of July. Now, we've highlighted in recent videos why we think this bull market can be sustained heading into the end of the year, as it is supported by strong fundamentals. But a pullback here would be natural and actually quite healthy to see. It's possible we're a little bit early, but we are going to be trimming a little bit more. of our allocation to US equities, especially on our more tech-focused trades like Spotify, KLAC, and IBM that have been melting up along with this market. But we are going to be keeping the parts of our portfolio that we think can hold up quite well during this correction, Bitcoin being one of those positions that we think could actually benefit from the large cap names pulling back. If you want to follow all of our trades, what we're buying, what we're selling, along with a complete overview of our entire strategy, day by day, week by week, make sure you're subscribed to our website at bravosresearch.com.